those little signs of stress were starting to show even before we got to Liberation Day.
With this level of volatility, you have to be incredibly careful because it's very easy to make quite a horrible accident.
Don't throw the baby out with the bathwater.
Welcome to Fidelity Answers, the investment podcast from Fidelity International, where we tackle the pressing questions our clients are asking. I'm Ben Mashinsky.
And I'm Rosie McMillan. Today we're asking, how should investors respond to a changing America?
It's been an extraordinary and volatile start to 2025. The big bet at the start of the year was that US markets would continue to move higher, given the new administration's commitment to reflating the economy and cutting regulation. Instead, we're living in a time of nerves. We're speaking on Wednesday lunchtime, about a week after President Trump's Liberation Day tariff announcement. And so, Rosie, is it time to rip up the investment textbook, start again? Do we need a new paradigm for investing?
Last week, we hosted a client symposium here in our offices, and I was asked exactly that question from the CIO of an insurance company, actually. And I'm not sure that this is a good course of action to rip up the investment process, to start with a new framework. I think perhaps more prudent measure would be to do three things. One, to reassess all your assumptions and your hypotheses that are going into an investment process. Secondly, to make sure you're kicking the tires, doing your scenario analysis and applying some stress tests to what you want to invest in. And thirdly, to make sure you have an adequate risk framework. Don't throw the baby out with the bathwater. So today we're joined by some colleagues of mine from the multi-asset team who look at fixed income as one of several asset classes that they can invest in. They look at everything from equities to credit, from gold to real estate, and they look at getting the best out of the markets for their clients. So welcome to Talib, Sheikh, and to Caroline Shaw.
Thank you.
Yes, indeed. Welcome to you both. And so, Talib, perhaps you can kick us off with one sentence to describe how this moment feels to you in the markets.
Tiring, I think. Bear markets are supposed to be tiring, but it is where we can hopefully add some value for our clients.
Excellent. Yeah. And you, Caroline, how are you feeling?
Well, it's an interesting time, but I'm trying not to feel too much, trying to detach emotions from the day-to-day investment decision making.
So, Talib, I think we've got to start by addressing the events of the last week or so and the tariff announcements. But if we wind the clock back to just over a week ago, we knew there were going to be tariff announcements. Liberation Day was widely flagged, and Trump and his administration were very clear that they were going to address trade. So what were your feelings initially when you saw the magnitude of the announcements? And then how did you respond initially, and how has that strategy developed over the last few days?
I think, like everybody else, we were surprised at the magnitude and the scale of them. 10% minimum tariffs across everybody globally. Clearly, the market has moved to price a very dangerous downside scenario. Whether that actually comes to realize, I think, is a question. I do think the one thing that is important, though, is that this is really extending trends which were already starting to become in place. So we're really thinking about the world in many ways becoming more regional, US on its own, a pan-European bloc, and possibly a pan-Asian bloc. And I think these tariffs mean that trend, which has already started, it's to some sense has accelerated from here.
Yeah, it's interesting. And it seems to me, I don't know if you would agree with this, but it seems to me that the initial reaction was very much on the growth implications in the US. So we saw, cuts priced into the expectations of the market and what the Federal Reserve would do on monetary policy. At one stage, I think we saw 5 or even more cuts. I think it's come back slightly from that in recent days. But there has been less of a focus on the inflation side of the argument. Yeah. And if you look at market commentators and forecasters out there seems to be quite a symmetric implication, percent or so off growth, percent or so added to inflation. How were you surprised to see that? How do you think about the growth environment now when you look at the US?
I mean, clearly to the downside. I think the thing that has surprised us, me, was really how weak the dollar's been. There's been a lot of kind of academic research that said once tariffs were implemented, a lot of that will be cushioned by a rise in the dollar as that capital flowed back into the States. And actually the opposite has happened. So that inflationary dynamic that you're seeing in the States, it to some degree has been turbocharged by that. So we've certainly seen capital flowing out of the States, both in the equity market and also more recently in the bond market. That's brought the dollar down. So that inflationary dynamic, I think, has become more prevalent. And that's really going to be seen by low-end US consumers, which will then feed through into low growth and low consumption further on. So I think that's the balancing act that we're working through. It's not a slam dunk, it's all growth or it's all inflation. The reality is it's going to be somewhere in the middle.
Yeah. And that move away from the dollar, I mean, do you think there's a question mark over the reserve currency status as the dollar, or is that one step too far in your opinion?
I think it's one step too far, but I do think we've seen, I remember when I started off my career, as a percentage of global equities, US equities, I think they're about 37%. They're currently about 72% of the global equity market. We've had 10 to 20 years of capital being sucked into the States, huge amounts. Now, we're not saying all of that is coming out, but clearly at the margin, when that starts moving, that's going to weaken the dollar. Does that mean the dollar stops becoming a reserve currency? I think that's a step too far. But I do think there is perhaps an opportunity for the euro to kind of step up to some degree here. But again, we're talking from incredibly low levels. So too early to say this is the end of the dollar.
And so we've talked about inflation. Caroline, are there any sort of economic indicators that you're looking beyond that to sort of give you a sense of how the markets will go? And are there any indicators that are flashing red for you at the moment?
So we're looking at, I spend quite a lot of my time looking at the bottom up and trying to feed in what we're hearing from analysts and those conversations. When we look back to, say, mid-February, our forward-looking indicators that we look with our macro team, they were already indicating some signs of stress. And, we looked at consumers, we looked at corporates in the US, and they were in pretty good shape. But yeah, those little signs of stress were starting to show even before we got to Liberation Day. So I guess from a portfolio construction perspective, that meant that we'd already taken off a little bit of risk going into the tariff announcements day. So whilst that magnitude was definitely a surprise, the market reaction, we were already a little bit more defensively positioned to sort of, I guess, just get ahead of some of that. I think the consumer is in an interesting position, but the corporates as well.
It's interesting, isn't it, how policy changes in the US have sort of caused this tidal wave of reactionary policy potentially around the world. Do you see this as a trickle effect into other country policy making that is going to be triggered as a result of these moves in the US?
I think they have to. And I think it's woken people up. I think that's the best way of putting it. And made people focus, or made countries focus on what's needed here. So yes, it's well known that there's been an underinvestment in defence, and it seems that is going to be a bit of a catalyst certainly for the UK, like you mentioned, and also for Europe. But it will come across other areas too. And it's nothing, having a 10% minimum tariff slapped across everything, no matter what your trading relationship was with the US, is certainly a bit of a wake-up call to not let things just drift. So I think what I think the uncertainty is now is how do you negotiate from that position, given that the trade is the other way around. We're in a surplus. So I think from the UK's perspective, that becomes quite an interesting conversation about trying to understand what the US is wanting to get out of this, because it's going to be more than it first meets the eye, should we say.
And Talib, I think, I don't know whether you're following the Chinese market very closely, whether you have investments there, but I was talking to some of my colleagues in China this morning, and there seems to be this sense that, or this expectation that the policymakers there will announce significant support packages to compensate the domestic economy from what is an extraordinarily punitive tariff that China will be facing in the US.
Yeah, I think the Chinese have taken the view that this is a long-term strategic threat, and it requires not only a short-term cyclical answer, namely easing of financial conditions and also some fiscal stimulus. I think they're also realizing that they're going to have to pivot, change the way that their economy has been run for the last 10 or 15 years. I thought it was really interesting that we saw an agreement between Korea, Japan and China, 3 countries that have a somewhat checkered history, coming together to come to a deal around semiconductors. It really gives you an indication that people view the world as being more fractured and changing, and actually that requires a strategic change of direction rather than just a kind of cyclical sticking pasta.
Yeah. And when you look at the markets, one thing that struck me and still strikes me is that different asset classes seem to price. They seem to be pricing in different likelihoods of different events, particularly if you look at the expectations or the possibility of a US recession. Our quantitative research team this morning were talking about the US equity market probably pricing at about a 50-50 chance of a US recession given current market levels. Whereas if you look at credit markets, though they have weakened recently, they're still only, investment grade only 10 basis points wider, high yield maybe 50 to 100, but they're still not in recessionary territory. They're sort of maybe a 30% chance of a recession there. So, I mean, how do you approach different asset classes in your portfolios when you're looking at this? Do you start with your expectation for what you think the economy is going to do, or do you start with the level of pricing that you see and work back?
I mean, it's a little bit of both, because obviously pricing is really important. And certainly at the moment we're looking at where are the opportunities to hedge. So it's not just looking at pricing, it's then looking at the correlation between asset classes. One of our colleagues in Hong Kong presented a really interesting analysis this morning, looking at the comparison between today's environment and the 2018 environment, and how different asset classes are exhibiting different correlation to the equity market this time around, and where those opportunities might lie. So I think there's lots of factors feeding into those decisions. I mean, remember, we were all positioned before this came along, so we're not starting with a blank sheet of paper. It's adjusting portfolios, and even that point about looking at how you change your positioning when equity markets have sold off so significantly at the moment. How to react to those, it's incredibly short term, and we're long-term investors as well, so we're trying to react tactically in the short term, and pricing, the fundamental pricing for assets is not coming into it in that move yesterday, for example. It's pure sentiment driven.
I think also you have to be humble and say, I don't know.
Yeah.
I think when you're looking at your portfolios, my view is you should try and liquefy your portfolios. You shouldn't be tempted to try and bottom fish, particularly in things that are illiquid. And I think you can, and I think now is a very good example. Can we look forward 1 year and have confidence on where earnings are in the equity market? Can I have confidence on where GDP and inflation is likely to be? The answer is, I don't think I can. So we need to think about how do we build a portfolio that's resilient across a number of outcomes. Some of them are going to be positive, some of them are going to be negative. And as you say, with this level of volatility, you have to be incredibly careful, because it's very easy to make quite a horrible accident.
Yeah, and spreads have been in the market. The spreads in certain assets have been widening with news flow. And I think trading that tactically has become incredibly tricky when there's, during the market trading hours, when that news flow has been quite acute. I think it's been a fool's errand trying to chase prices at that point.
Yeah, I mean, it strikes me that this is not a normal crisis. That isn't an oxymoron in itself. Yeah. But ordinarily, when you have a crisis in markets or severe dislocations in market, you see things like people flocking into the dollar. As we've discussed, that hasn't happened. People flocking into US Treasury markets. Treasuries have rallied a bit on occasion, but in general are selling off and continuing to sell off this morning as we speak. You see widening in the cross-currency basis as people try to scramble and pay up to be funded by dollars. And we haven't seen that. We've just seen a few basis points widening there. So it's not normal. And I guess it's because the epicenter of the crisis is in fact the US. And people would ordinarily see that as a safe haven. So it is very difficult to manage in that event. But without wanting to be a complete doom mongerer, you've got to think, when you see moves of this magnitude, that someone out there is on the wrong end of these moves. And there's probably some news item that's going to hit the screens at some point that's going to make you think, this is the point where markets are going to tumble further, or this is the point where things are going to turn around and we're going to see some action. But at the moment, we haven't been aware of that. What areas are you focusing on most closely as warning signs that this might happen?
I think you have to break it into two parts, really. The first part, as you touched on, really is the financial market pricing, and we've seen things like the VIX, the Greed and Fear Index, pop to 60, and as you say, some of the pricing around treasuries. But also, if we think longer term, when does this morph from what at the moment is a financial crisis into an economic crisis? And that's really when you can start thinking about, well, is it a long-term recession? Is it a depression? Lots of chatter around the Smoot-Hawley Act, etc. So the three things I'm really watching on that. Number one would be the credit market. As you say, they have widened, but they're still functioning. If credit stops flowing to the economy, that's typically very bad. The other one is confidence. Clearly, that has been knocked, but it can still fall further. And the third one really is the labour market. Again, we've seen people stop hiring, but we haven't really seen layoffs yet. So if we see those three things start to get worse from here, then that recession probability goes up, and then you really have to think we're digging in for the long haul.
Yeah. How are you thinking about commodities at the moment? Obviously, we've seen significant moves in the gold price. Talk to me about your views in commodities in general.
So I guess the good news is the oil price is down fairly significantly. That certainly helps the inflation dynamic. Petrol prices, gas prices down, and generally the weakness across the commodity complex. I think gold is something really quite unique. We're quite bullish on gold. I still think, obviously, we had an all-time high last week before. It's come off a little bit. And I think it goes back to that idea about the old order is fracturing to some degree. And so people are starting to think, can I trust the States? Can I trust the dollar? Can I trust treasuries? And we're not saying that the US is going to default, but clearly that risk has gone from being zero to something above zero. And I think that's caused a change in perception around gold. So you've seen central bankers buying it fairly indiscriminately, and certainly I think that continues. So the uniqueness of gold has become more unique, and I think has become more desirable in what we think is a changed world as we look out for the coming 1, 2, 3, 5 years.
Yeah, it's always been the commodity that is not demand supply driven, unlike oil or economic cycle driven. It's always been that potentially inflation hedge, but that anomaly. And yes, your point about lack of demand for treasury auctions, there's a read through there.
And I always think gold's not really a commodity, it's a currency.
Yes. Yeah.
And so it behaves in a slightly different way. As you say, cocoa is driven by supply and demand. Gold is driven by other things as well. It has a unique property.
Okay, so we've spoken about what's happening, but how should investors respond? Talib, putting aside the pros and cons of the policies we've seen enacted, how has your approach to investing changed in the past few months, if it's changed at all?
Well, it really hasn't. I think process is absolutely critical in these kind of market environments. And our process is really built around three things: fundamentals. Where is our economic analysis? Where do we think the global economy and regional economies are going? As we've touched on, that's quite hard to forecast at the moment. Valuation. Clearly, we have seen a derating of assets, but we wouldn't say that there's a massive value buy here. So really, we're driven by technicals at the moment, trying to think where are things underpriced, where can we put hedges into the portfolio. But most importantly, it's about trying to protect our clients' capital. It's about trying to make sure that we survive, because when we do come out of this, clearly there will be great investment opportunities, but you have to be ready to grab those, and don't try and grab those too early.
What about you, Caroline? What adjustments are you making to the way that you're investing?
Well, no significant adjustments in that sense, but it has brought back home to me that good advice I've received and read about over the years, which is that if you feel like you need to make a decision, go for a walk around the block and reassess whether you need to make that decision. And I think it is good advice when the markets are moving at the scale they've been moving, just making sure that you're taking the emotion out of trading decisions and reflecting before trading is quite a good reminder. The one thing I have noticed, however, is that when you have an idea in the current markets, if you don't move swiftly, the markets are moving so fast that sometimes that idea can be gone. And I'll give you a good example, which was the night that Chancellor Merz came out with the fiscal package for Germany.
Right.
And I was chatting with Chris, who I manage funds with, and we were chatting about our Bund position and suggesting we might want to take it off. And that night, just before the market closed, we acted to do that. What a good job. But it was that whole point was we could have easily delayed that decision to the following morning and it would have been gone.
So you go for a walk around the block, but not too long a walk.
Yeah, and I think it's trying to balance that. You need to get perspective and make sure that you're within your process still and you're adhering to sort of a discipline, but also being really mindful that markets are moving and sometimes the opportunities are right there and you've got to take them. So I think that's become, it has become trickier to manage that simply because of the volatility in the markets.
Mm-hmm. And who do you speak to when you're looking for some colour on this? I mean, have you been speaking to any of the analyst community that we have in the company and getting some read through on the individual company data?
Yeah, I find talking to our analysts is so useful just to hear that on the ground feedback and what they've been hearing from the corporates. And again, I'll give you a good example. I was chatting to our one of our US, so Toronto-based US consumer analysts only this week, and it was really to gauge what was going on in the consumer staples space and how corporates were trying to respond to these tariffs, bearing in mind that in the consumer space, the margins are quite tight already in that space.
Just to pick up on that point, of course, no one's got a crystal ball, but we do have some tools at our disposal. Fidelity's regular analyst survey tracks the opinions in aggregate of more than 100 equity and credit sector analysts who are in regular contact with the companies they cover, thousands in total. This month, we asked them where they think tariffs will have the biggest impact, and the results aren't what you might expect. Hi, Ben. Thanks for joining me today.
My pleasure.
So you are the editor of our monthly analyst survey. And of course, tariffs are on everyone's mind at the moment. So what have the most recent results what are they telling us about what companies are thinking about tariffs?
Well, there's a really interesting picture emerged, actually, Ben, when we ran the survey most recently. We did it just before the announcement, but obviously everyone knew what was coming. Not exactly, but they knew there would be an announcement on tariffs. And so we said to our analysts, what effect do you think tariffs will have on the profitability of the companies you cover over the next 12 months? And the picture that emerged is the further east you go, the fewer analysts as a proportion of that region were expressing concern.
Yeah.
So in North America, 72% of analysts covering North American companies were saying, we see this having an adverse effect on profitability. That drops to 27% for China. So there's quite a big contrast there. And it makes a sort of sense because we're used to hearing about tariffs as something that are imposed on a country, but in actual fact, they're levied on the importer. And so the closer you are to the epicenter, so it would seem from our results, the more concerned you are.
Right.
And I think there's a really nice compare and contrast to be done with a couple of analysts who cover consumer sectors, one in China, one for North America. The China analyst, he's looking at it and he's going, yes, tariffs could be a headwind, but most of my companies are domestically focused and this headwind could prompt more government stimulus, which could actually have a positive effect for Chinese consumers and for companies to serve them. You contrast that with one of our North American consumer analysts who's saying tariffs could be very inflationary and we have to be looking at the possibility of a pullback in consumer spending. So I think that illustrates the different mindsets that are emerging. That's only two analysts, but when you look at the results as a whole, they track with the picture that we're seeing.
How have the results been when it comes to things like manager sentiments? Because obviously our analysts talk to a lot of managers in those companies.
Yes, and we ask this question every month, actually, based on, as you say, the fact that analysts are talking to companies, reading everything they put out, analysing them, immersing themselves in the space that they cover. And they could see that company managers were worried. If you break it down regionally, again, it's North American sentiment that seems to be taking the big drop.
Yeah, and so how about sectors? Because of course, it's quite clear there are going to be a lot of losers from tariffs in general. But are there any sectors that stand out as perhaps having a few winners in there as well?
Yeah, so an example is medical equipment and health tech in China. I was speaking to an analyst this morning who was explaining that the US market only accounts for around 5 to 8% of their company's sales. So while there's an impact from tariffs, it's relatively muted. And so that's a sector that's reasonably well insulated. But I think the thing to take away from it all is it's a case of drilling down to find those fundamental stories, and it's going to be about the interplay between where a company is, which country it's in, how they're responding to tariffs, and the particular part of the sector that they're in that will determine how they fare going forward.
Excellent. Ben, thanks very much for your time.
You're welcome.
That was Ben Traynor talking to our Ben just a little earlier. So back to you, Caroline. Where are the safe havens? Where can you invest and sleep a little bit easier than you would do otherwise?
Yes, I'm still sleeping okay, but the time will come. I think gold has been an obvious safe haven, despite the recent increased correlation with the equity market sell-off, which we think was probably down to sort of hedge fund losses being covered and people having to sell liquid assets. Likewise, in some of the bond markets. So I think UK gilts look quite interesting because we think that the rate cuts will be coming from a higher level. So in that government bond space, maybe UK gilts. In that other space, commodities, gold. In the currency space, yen looks more interesting. And then equities is the interesting one because obviously you want to be risk on. You have to have some equity exposure. We don't want to sell everything to cash. But I think in the equity space, we were relatively defensively positioned in things like minimum volatility type positions. And they've held up a little bit better than the broad market. I wouldn't describe them as a safe haven in the sort of total return construct. Those other assets I mentioned have been better. But thinking about owning equity risk and min vol has been a little bit better.
Mm-hmm. What about you, Talib? Would you like to add to that?
Yeah, I think the reality is that many of the safe havens are really quite expensive now. So the old adage, you buy insurance before your house burns down, not after. The question is the house half burnt down or fully burnt down here? So overpaying for protection, I think, is something which you have to be quite careful not to do. I agree with you on the currency trades. So the Japanese yen and also the Swiss franc look interesting. And the other thing, I think cash here is very different to the great financial crisis. You can get 4.5% on cash quite quickly. In the great financial crisis, rates were cut to zero. So holding some cash as dry powder, I think, is a reasonably sensible thing to do. And we certainly, in my portfolios, we have about 10, 12% in cash at the moment.
And so I just want to sort of cap off the discussion. We've talked a lot about, crisis, how to invest in a crisis. Where does this stand for both of you in terms of crises that you've seen, 2008, 2020, and, lots in between? Is it up there yet with those kind of crises?
Unfortunately not. I don't think so. I think the reality is that I said at the start I was tired. The bear markets beat everything out of you, be it the tech bubble, be it the GFC. You really feel that all hope is lost. And unfortunately, I'm not sure we're there yet. So, but we can turn around. I think every crisis is different. At the moment, this is a man-made crisis. Mm-hmm. If it morphs into an economic crisis, then we're playing a different game because then it's months/years. I don't think we're there yet.
It's weird, isn't it? Because we're normally, again, normal crisis. But in a crisis, you look at policymakers to help resolve those crises. Yeah. Now we're in a crisis which is driven by policymaking. So it's almost turning it on its head. And if you compare it with the GFC, that was a banking crisis. That was systemic risks that were uncovered and strained in the banking sector, which then bled through into the real economy. Whereas what we have now is a policymaking economic crisis that might bleed into the banking sector. Yeah. So it's almost like turning everything on its head, isn't it? What about you, Caroline?
I can go back to the tech crisis of early 2000s as well, but this is not there yet either. So for me, I think of the crises I've been through as a portfolio manager, the global financial crisis still stands out as the most tricky. It was long, it was relentless, it was every day red screens. If this ends up being like that, we are just at the start. But I think, like we've just talked about, there are exit opportunities here. But we're not feeling in that depth of despair that definitely at the end of the global financial crisis we were feeling.
So we've covered a huge amount of ground. Thank you for all your comments. I'm going to try and summarise some of the ground we've covered. I think coming into this period, we'd been expecting a slowdown in major economies. And now we find ourselves possibly teetering on the edge of a recession environment. We do see this as a new paradigm for trade policy and US economic policy, but not necessarily a new paradigm for investing. We are revisiting all our investment assumptions, but not necessarily changing our process. And we're trying to take advantage of tactical opportunities where they arrive, having gone for a walk around the block. And volatility is not going to go away anytime soon.
Mm-hmm. And that is almost all we have time for today. But before we let you both go, we play the Fidelity Answers game, hot cakes and hot potatoes. What would you buy like a hot cake and what would you drop like a hot potato at the moment? Talib, you first.
So I think we've touched on this. Gold, I still think has a place in portfolios, and I think will go higher. What's the hot potato? It's still the Magnificent Seven. I think people still hold them, and I think on any bounce, people should be taking this as an opportunity to get rid of those.
Caroline?
So gold would have been a nice one, but Talib's taken that. So I'll give an interesting one. So knowing that we need to have some equity exposure, something we're looking at is European defence. So not necessarily a hot cake, but it's at a price level it was at back in January. So it's had a big correction, and there is a strong structural capex spend coming in European defence names. So that looks interesting. On the hot potato, an interesting twist on it again. We had some protection running into this crisis, thankfully, in the form of put options in some of the portfolios. And the interesting debate for us is selling those, knowing or not knowing what's ahead, how long to retain that protection for, knowing how difficult it is to reprice it because it is now expensive. So there's my hot potato, but it's not a sell today necessarily. It's a watch and see.
An optional potato.
An optional potato, yes.
And a warm cake.
And a warm cake, yes. It's very, very much narrowed my choices today, yeah.
And we also ask each month our guests to recommend one book they've read or something they've watched or listened to recently. So, Talib, what would you recommend?
Well, we've talked about the financial crisis. One of my favourite films of the great financial crisis is Margin Call.
Oh, yeah.
And I watched that a couple of weeks ago just to get me going for how bad things can get.
So mine's a book that I'm currently reading by William Green. It's Richer, Wiser, Happier. Interviews with some of the world's best investors, interviews taken over the last 25 years. Really interesting and great to be reminded of how the great minds of the investment world work. And take a walk around the block is one of the key themes of sticking to your process. And sometimes when you're in a crisis moment, it's just really good to be reminded how the great investors do it.
Great.
Excellent. I think that really is all we have time for now. Thank you to Talib Sheikh, Caroline Shaw, and Ben Traynor. You can find more information on what you've heard here today on your local Fidelity website or at fidelityinternational.com. If you've enjoyed what you've heard, then please like, share, and subscribe.
The producers today were Holly Eastman and Patrick Graham, with production support from Connor Bailey. The editor is Seb Morton-Clark.